Using AI, I hacked ICT Fair Value Gaps to find out exactly what they are, why they occur, and how you can use them. Now, the great insight I provide is I analyzed the BTC blockchain to see exactly what is going on under the hood. And this was only made possible using artificial intelligence and the new ChatGPT 03, which is available on the Pro subscription. If you don't have access to the Pro subscription, fortunately, I will be sharing all the insights with you. Now, there's a lot to get through, so ensure you stay to the end so you understand the key lessons that I'm trying to impart on you. Exactly what a fair value gap is and how to use it. So this is a query I ran, some analysis on fair value gaps and blockchain. So firstly, I asked ChatGPT, can you analyze the Bitcoin blockchain to ascertain patterns in behavior of transactions by certain players? Now, unfortunately, within the futures markets, we can't see exactly who is buying or selling. That data is private. And even if the exchange reports who is holding positions, sometimes it's the investment bank or a fund that is the intermediary party. Okay, but with the blockchain, because we can analyze the wallets, we can see exactly who is creating these fair value gaps, okay, and whether these are useful and how they are used. So in short, ChatGPT can use the blockchain to analyze things on our behalf. And this gives us amazing insight into smart money concepts such as order blocks, fair value gaps, mitigation blocks, rejection blocks. We have the information now, okay? You can piece it all together via the Bitcoin blockchain. So we want to focus on the whales, the people who are putting in the biggest trades, to understand what a fair value gap is. Now, I told ChatGPT I'm interested in whales and whether they have been buying Bitcoin in price ranges I will give you. But firstly, we have to ensure that ChatGPT is using the correct definition of a fair value gap. Sometimes it will use a body-to-body fair value gap, but it's really the wick-to-wick one we're interested in for the purposes of this presentation. Now, a body-to-body fair value gap is also very valid for different reasons, which I may explain in future videos on this YouTube channel. So it goes through the standard definition of a fair value gap, and I confirm that this is correct because I've run analysis in the past where it uses the wrong fair value gap. So this is why with AI, you have to ensure that its assumptions are correct. Okay, so the fair value gap is correct, and then it just confirms it using some code. Now, this is an important step. I provided it with the market data. So all you need to do is within TradingView, find the chart that you want on the time frame, and you can export the data. Once you export the chart data, you can then provide it as an attachment in ChatGPT. This will allow you to do some amazing backtesting, which will save you weeks worth of effort. So what I said was, on the weekly time frame for Bitcoin, for the data I provided, extract all of the weekly bullish fair value gaps. I want to know the date of the weekly fair value gap candles, which is the middle candle of the 3-candle formation, the high of the fair value gap and the low of the fair value gap. So for instance, this fair value gap occurred on the 4th of November 2024. This was the low, this was the high. This is the information I want. Okay, I want to know when the fair value gap occurred and between what prices. And now, this is key. For each weekly bullish fair value gap, extract the range. We will call these weekly demand zones, right? So now I'm giving it some definition so we can start working with the information. Okay, range has been extracted. Demand zone low, demand zone high. Now, for each weekly demand zone, use the blockchain to identify the whales who bought Bitcoin in this demand zone during that fair value gap week. So this was the bulk of the work. Okay, so it used Glassnode and some various other sources to understand who was buying at this price at this time. And it resolved the wallets into the actual name so we can understand that. Using the blockchain, show me all of the whale wallets which bought BTC in the last weekly demand zone. So I conducted this analysis some time ago. So the last one was on the 5th of May. So let's find it. There you go, 5th of May. So this is the one I was looking at when I did this analysis. Okay, there we go. So there's the low, there's the high. Who was buying in this zone? MicroStrategy was buying in this zone. BlackRock ETF fund, the Fidelity ETF fund, and the 21 shares ETF fund, as well as a Binance cold wallet. So now let's do some teachings. What is a fair value gap? Okay, what is a fair value gap? A fair value gap is not created by an underlying algorithm. Okay, instead, it is when the big institutional players, the whales, when it comes to Bitcoin, specifically BlackRock, Fidelity, MicroStrategy, it's when they are buying. And because they are buying so much and there are not enough sellers there, price gets pushed higher. Okay, that's what a fair value gap is. Because anytime price is in this zone, it gets fully eaten up. All the cells get eaten up to such an extent that price moves. Now, so what can you assume? If the big players are buying in this zone, okay, this is where Michael Saylor decided he wants to buy, and price moves away, what is he going to do? The next time price goes there, he's going to fill the rest of his order. That's what a fair value gap is, okay? A fair value gap is not some master algorithm painting up and down a range because it's not painted before. Okay, that is complete nonsense. It is an institutional player who's got deep pockets, who wants to buy at a specific level, and whenever price dips into that level, they will continue to buy. Because what has happened is they wanted to buy a certain amount. By buying and using up all the cells that are available in the market, price is pushed away. That whale still has pending orders. They still want to buy more BTC at this price. So anytime price dips back in, they buy it back again. Dips back in, buy it back. Okay, until there are no more sellers left in the market, and then price moves higher. Okay, it is not a master algorithm. However, the big players trade their own algorithms, and this is how I trade the golden bullet. Okay, the golden bullet understands how institutions trade, and we wait for their algorithms to kick off, and that's what we are backing off of. Okay, there are telltale signs on when their algorithms start, and that's how we jump into golden bullet trades. Okay, ignore what you've been taught about fair value gaps. It is not about painting up and down because the algorithm wants to produce a fair situation where everyone gets a chance to buy. That is nonsense. It is literally a big player is interested in this price zone, a demand zone. So whenever price dips back in, they will fill the rest of their orders. Now, why do fair value gaps sometimes be broken? It's because once this person's bought their BTC, let's say they want to buy 100,000 BTC. Once they bought their 100,000 BTC, that's it, they're holding. They're not buying anymore. So that's why sometimes a fair value gap is no longer respected, because this person is no longer buying. They have filled their lot. Okay, this is what you need to understand about fair value gaps. It is a demand zone. Okay, pending orders rest in fair value gaps. So continuing my analysis, I then asked it, please do the same for the previous 10 weekly demand zones. This would have taken too long, okay, for the free plan that it uses to access Glassnode. So in the end, I just asked it for 5 past weekly demand zones, which is your fair value gap. Okay, go look at Chris Laurie's work. Okay, when he talks about liquidity voids, that is actually what a fair value gap is. That is the true definition of a fair value gap. It's not about a master algorithm being fair and ensuring things are offered both ways. Okay, that's nonsense. It is literally a demand zone where institutions are looking to buy, and once price dips into it, they will buy until their initial order is fully executed. So who were the key players? Okay, BlackRock was buying, MicroStrategy was buying, Fidelity were buying. These are the guys who are pushing price. Now you understand exactly who is buying and where they're buying. You just have to wait for price to drop in to that demand zone for whichever strategy you want to trade. Okay, this is the key to trading with institutions. You can run the same kind of analysis for supply zones, and you will see things such as SpaceX Treasury sold a bunch of BTC. They lost They lost, let's see, they lost about $373 million when Elon Musk's SpaceX sold his Bitcoin. Okay. There's a lot of information here. There's a lot of analysis that you can do. And I go into a lot more details in my private mentorship. But the key takeaway is fair value gaps are institutional demand zones. They are looking to buy within that price range until their order has been filled. Use that as your point of interest for your lower time frame entries. This is how you start to align yourselves with institutional traders. If you would like to learn about my time and price golden bullet strategy, which I use for index futures, crypto, forex, energies, and metals, there's a link to my mentorship below.